In the first quarter of 2026, Amazon's free cash flow plummeted by 95%,
Yep, 95.
which is wild, right? Because for almost any normal company, a drop like that is, it's the undeniable signal of a death spiral.
Oh, absolutely. Panic ensues, the stock tanks, and, well, the CEO starts updating their resume.
Exactly. But for Amazon, that 95% drop is uh, entirely intentional. It is the exact cost of building a $147 billion unassailable moat around the future of artificial intelligence.
It really completely flips traditional financial analysis on its head. I mean, if you just glance at the top line revenue and bottom line profit, you're missing the actual mechanics of what this company is doing.
Right.
You really have to look at the massive, just planetary scale infrastructure that they are paying for right now.
And that is exactly what we're doing with you today. Welcome to the deep dive. We've got quite a stack of sources on the table to figure this out for you.
We really do.
Yeah, we are pulling directly from Amazon's official Q1 2026 earnings release. Their incredibly detailed financial presentation slides and their comprehensive Form 10Q filing with the SEC.
Plus, we're incorporating some specialized translated analytical notes that break down the technical side of their AWS and AI strategies.
Which are so helpful.
They are. Those translated notes are crucial because they take the raw financial data and sort of synthesize it into the actual strategic vision, showing us the physical hardware behind all those dollar signs.
So our mission for you today is to cut through all the heavy financial jargon. We're going to unpack how Amazon's staggering AI investments are impacting their bottom line.
The real bottom line.
Right. And we'll explain the physical mechanics of why their custom chips are reshaping the tech industry and parse what this high-stakes strategy means for the everyday investor. Okay, let's unpack this. And I think we should start with the flashiest moves first.
The partnership.
The partnerships. Because, the scale of these deals dictates everything else we are going to talk about today.
Unbelievable numbers, truly.
Let's look at the OpenAI relationship first. In Q1, Amazon dropped $15 billion in cash into OpenAI's Series C preferred stock.
$15 billion. Just boom.
Yeah. Now, typically a Series C is for, a growing startup looking to scale. But at $15 billion, this is something entirely different, and it doesn't even stop there. Amazon also signed an equity commitment letter for another $35 billion.
Which tells us this isn't just a standard venture capital play.
Right.
The key detail here isn't the equity at all, really. It's the underlying infrastructure tie-in. As part of this deal, OpenAI is committed to consuming approximately 2 gigawatts of Amazon's Trainium computing capacity starting in 2027 to power their frontier models.
Hold on. I want to make sure we don't just gloss over that term. 2 gigawatts.
Yeah, it's massive.
We usually measure computing in, processing power or terabytes, not gigawatts. That's how we measure power plants.
Precisely. A single gigawatt is roughly the equivalent of the power generated by a nuclear reactor.
Oh, wow.
It is enough electricity to power a medium-sized city. So Amazon is basically dedicating 2 cities' worth of continuous electrical computing power just to OpenAI's server racks.
And OpenAI isn't even their biggest partner.
Nope.
You look at Anthropic. Amazon previously invested $8 billion in them. Then, post-March 2026, they dropped another $5 billion and opened up a massive new $20 billion financing facility.
It's staggering capital.
And just like the OpenAI deal, Anthropic has secured up to 5 gigawatts of current and future Amazon Trainium chips to train their models.
Right.
And the result is that on Amazon Bedrock right now, they've got OpenAI's GPT-5.4 in limited preview, Anthropic's Claude Opus 4.7, and the new Claude Mythos model.
It creates a really fascinating dynamic. Amazon doesn't actually need to win the AI model war themselves.
They just host the battle.
Exactly.
Right.
By hosting all the premier models on Bedrock, they turn AWS into the ultimate toll booth. Whoever wins the AI race, Amazon collects the fee.
But I have to challenge the premise of these deals for a second.
Okay, go for it.
It sounds like Amazon is a commercial landlord who isn't just renting out premium office space, but is actually taking their massive cash pile and buying multi-billion-dollar stakes in their tenants' businesses to guarantee they never move out.
I can see why it looks that way.
Right. So is this true organic growth for AWS, or are they just artificially buying cloud market share?
What's fascinating here is the brilliance of the capital loop they've created. It's incredibly easy to cynically view this as just buying revenue, but it's actually a symbiotic ecosystem.
How so?
Well, in the cloud business, idle servers are your biggest enemy. When a server sits empty, it is just bleeding money. So by locking OpenAI and Anthropic into these multi-gigawatt deals, Amazon guarantees massive, continuous utilization of their infrastructure.
Ah, so the servers literally never turn off.
Never. And guaranteed relentless utilization drives down the per-unit operational cost.
Because you aren't guessing what demand will be.
Yeah. Right. It gives Amazon the predictable scale they need to keep investing in the next generation of infrastructure. They aren't just buying customers, they are funding the exact companies that justify their own aggressive expansion.
Okay, so Amazon has promised 7 gigawatts of computing power to 2 massive AI companies.
Yep.
But if they try to fulfill that promise using standard, off-the-shelf hardware, they bankrupt their own margins.
Oh, absolutely. They couldn't afford the electricity, let alone the chips.
Which brings us to the actual physical mechanism making these partnerships profitable. Their custom silicon.
The custom hardware layer is the entire secret weapon of this Q1 earnings report. Without it, none of this works.
The numbers are just massive. From the translated notes, we see their custom silicon business, which includes the Graviton CPUs, Trainium AI accelerators, and the Nitro system, has crossed a $20 billion annual revenue run rate.
And it's growing at triple digits year over year.
Exactly. AWS landed over 2.1 million AI chips in the last 12 months alone, with more than half being their own custom Trainium chips.
Though it's definitely worth noting they are still bringing in over 1 million NVIDIA GPUs starting in 2026.
Right, they can't ignore NVIDIA.
No, you have to offer what the broader market wants. But the internal shift is clear.
True, but the real-world efficiency of their own chips is where the magic happens. Like, the sources point out, Uber is currently using Graviton 4 chips to match riders with drivers in fractions of a second.
And they use Trainium 3 to train their routing models.
Yes. And Meta is deploying tens of millions of Graviton cores for complex agentic AI workflows. And then there's Amazon Biodiscovery, where Memorial Sloan Kettering used this custom compute power to simulate complex protein folding.
That example blew my mind.
Right. They cut the design time for pediatric cancer antibodies from months down to weeks.
Yeah, because when you are running billions of protein combinations, the efficiency of the chip isn't just about cost anymore. It's about time to discovery.
Right. But here's where it gets really interesting for me from an operational standpoint. I really wanted to understand exactly why a custom chip is better than just buying the best NVIDIA GPU on the market.
The technical advantage.
Yeah. And from what the sources explain, standard chips are like renting a high-end sports car for your daily commute. Sure, it's fast, but it's wildly expensive and inefficient for sitting in traffic.
Right.
But building custom silicon, like what Amazon is doing, is like building a highly efficient hybrid vehicle specifically designed for your exact daily route.
That is an incredibly accurate way to visualize it. When you buy a general-purpose GPU, you are paying for silicon real estate dedicated to things you might not ever need in a server farm.
Like graphics rendering for video games.
Exactly. Trainium strips all of that away. It dedicates 100% of the silicon strictly to AI math.
Which makes it significantly cheaper to manufacture and to power.
Exactly. But the real genius is the Nitro system you mentioned earlier.
Tell me more about that.
Well, in a traditional data center, the main processor has to handle the computing, right? But it also has to manage the network security and the storage routing. It gets totally bogged down.
So it's multitasking.
Yeah. So Amazon built Nitro as a separate, dedicated system that entirely offloads the networking and security.
Oh, like taking the administrative work off the chef's plate so they can just focus on cooking.
Precisely. And by tightly integrating their custom Trainium chips with the Nitro network, they eliminate the latency, the time it takes for data to travel between servers.
So it's just much faster internally.
Yes. And this tight physical integration is what allows Amazon to offer significantly cheaper inference and training costs to their customers compared to cloud providers who are just, renting out third-party hardware.
Okay, so they have the multi-billion-dollar partnerships locked in, and they have the custom silicon driving down the physical cost of computing. Let's pivot to the balance sheet now.
The fun part.
Right. Because when you look at how these tech strategies translate to the raw numbers, the Q1 results are incredibly lopsided.
Oh, the disparity between their business segments right now is historically unprecedented. I mean, it's a tale of two companies.
Let's look at the top-line totals first. Total Q1 2026 net sales are up 17% year-over-year to $181.5 billion. Operating income jumped from $18.4 billion last year to $23.9 billion.
So on the surface, everything is growing beautifully.
Beautifully. But then you look at where that profit actually comes from. North America retail brought in $8.3 billion in operating income on a massive $104 billion in sales.
A huge amount of effort for that margin.
Right. And international retail brought in just $1.4 billion on roughly $40 billion in sales.
Then we look at the cloud.
AWS is a total anomaly. AWS sales were $37.6 billion,
Yeah.
which is up 28% year over year, by the way. Its fastest growth in 15 quarters.
Incredible acceleration.
But on that $37.6 billion in sales, it brought in a jaw-dropping $14.2 billion in operating income. The AWS operating margin reached 37.7%.
Almost 40 cents on every dollar is profit.
Just to visualize this for you, the listener, AWS is only about 21% of Amazon's total sales, but it generates nearly 60% of the total operating profit.
The disparity is wild.
So I have to ask, is Amazon essentially just a highly profitable AI cloud business that happens to run a giant break-even cardboard box delivery service on the side?
If you only look at operating profit, it absolutely looks that way. I mean, you can't deny the numbers, but you can't separate the segments because they feed each other in ways that aren't immediately obvious on a basic ledger.
Explain that, because the profit gap is just so stark. Why keep the low-margin retail business at all?
Because retail provides the volume and the data ecosystem. That massive retail footprint powers their advertising business, which is now generating over $70 billion in trailing 12-month revenue.
Oh, wow.
Right. The retail side drives Prime subscriptions and gives them unparalleled logistics and consumer behavior data. Retail is the volume engine.
And AWS is the margin engine.
Exactly. AWS is what subsidizes the relentless capital-intensive innovation across the entire company. Without that 37.7% margin from the cloud, Amazon simply could not afford to drop $15 billion into OpenAI.
Or build their Project Kuiper satellite network.
Or fund their autonomous vehicles, exactly.
That actually transitions us perfectly to the most crucial financial tension in this entire earnings report. If AWS is generating so much operating profit, where is all the actual cash going?
Yes.
Because this is the part of the report that completely shatters that simple school report card narrative we just talked about.
This is where we see the 95% drop in free cash flow, the real shocker.
Right. Let's break down the mechanics of this because it's vital. Operating cash flow, which is the money generated directly by the business operations, for the trailing 12 months was up 30% to $148.5 billion.
That sounds phenomenal, right?
It does. But then the trailing 12 months free cash flow plummeted 95% year over year. It dropped from almost $26 billion down to just $1.2 billion.
For a traditional value investor, seeing a company generate $148 billion in operations but only keep $1 billion in free cash is, well, it's a massive red flag.
And the cause is explicitly stated in the 10Q filing. It's a massive $59.3 billion year-over-year increase in purchases of property and equipment. Their total capital expenditure, or CapEx, reached $147.3 billion for the trailing 12 months.
And they explicitly note this is driven by AI and technology infrastructure investments.
Oh, and to make the numbers even more deceptive, net income spiked to $30.3 billion, but $16.8 billion of that was a pre-tax paper gain from the increased valuation of their Anthropic investment.
Right, it's not actual cash sitting in a bank account.
Exactly. So what does this all mean for retail investors? Are they burning cash too fast on servers that might be obsolete in 3 years?
Well, if we connect this to the bigger picture, we can see exactly why management is not panicking about the lack of free cash flow. You really have to understand the difference between OPEX operating expenses and CapEx.
Right. OPEX is your daily running costs. CapEx is buying the actual physical assets.
Exactly. This massive capital expenditure is a strategic choice. They are willfully sacrificing short-term cash flow to build a physical, insurmountable AI infrastructure moat.
So it's on purpose.
Very much so. For long-term stock value, this signals management's absolute conviction that we are in a once-in-a-generation infrastructure build-out. Think back to 15 years ago when Amazon was plowing every dime they made into building physical fulfillment centers across the globe. Wall Street screamed at them to show a profit.
And they ignored Wall Street, built the warehouses, and created two-day shipping, which locked in their retail dominance forever.
Precisely. Today, they are running the exact same playbook. But instead of physical warehouses for cardboard boxes, they're building digital warehouses.
Massive data centers packed with custom Trainium chips.
Yes. That $147 billion in CapEx isn't lost money. It is the physical foundation for the next decade of AWS revenue.
Okay, that clarifies the strategy. We've looked at the current bets, the custom silicon architecture, and the intense financial cost of laying down all this infrastructure. Finally, we need to look at the horizon.
What comes next?
Yeah. What is this massive $147 billion grid actually going to power? And what are the structural risks if things go wrong?
The horizon they are targeting is something called agentic AI.
Right. Both the earnings report and those translated analytical notes heavily highlight this. We've spent the last few years with conversational AI, chatbots, where you type a question and it types an answer.
As simple back and forth.
Right. But agentic AI fundamentally changes that mechanism. Instead of just answering, an AI agent takes multi-step actions across different software systems to achieve a complex goal.
It basically moves AI from a consultant to an actual digital employee.
Exactly. In the report, they outline Bedrock Managed Agents, their new creative agent for advertisers, and the Amazon Quick Desktop app. The Quick app doesn't just chat. You can tell it to pull data from an email, cross-reference it with a Slack thread, format it into a spreadsheet, and send it to your boss.
Which is credible.
They also highlighted Health AI, which analyzes personalized health data and can autonomously book follow-up medical appointments for you.
These agentic workflows are incredibly complex and require continuous, intensive computing power. They're the trains that will eventually run on those $147 billion worth of digital tracks that Amazon is laying down today.
But what if the trains don't show up, or they show up too late?
That is the big question.
So let's look at the actual risks management outlines in the 10Q filing. Management explicitly flags significant external headwinds. They note high capital requirements and extreme reliance on this hardware investment actually paying off.
It's a huge bet.
They are also facing macroeconomic volatility, like inflation and interest rate fluctuations, alongside serious foreign exchange risks. Furthermore, they outline mounting data privacy and antitrust investigations spanning both their global retail operations and AWS cloud services.
Which is a lot to navigate.
It is. And just to be clear, we are just impartially reporting what is in the SEC filing here. We aren't taking any political sides on the regulatory probes.
Right. Exactly. Just reading the risk factors they legally have to disclose to investors, which, frankly, is the standard reality for a company operating at a scale where their decisions impact global economic metrics.
True. But let me challenge the core technical assumption of this entire strategy. They are betting the house on their current hardware. But what if the underlying AI technology, like the algorithmic efficiency, evolves so rapidly that it bypasses the need for massive data centers entirely?
Or what if a competitor designs a fundamentally different kind of chip that makes Trainium look like a dial-up modem?
Exactly.
This raises an important question, and it is the central risk for anyone evaluating Amazon's long-term viability. The biggest risk isn't that AI is a fad. The real risk is the physical depreciation timeline of that $147 billion worth of servers and chips.
Because you account for that cost over several years on the balance sheet, assuming the server stays useful.
Exactly. Server hardware is typically depreciated over 4 to 6 years. But if the algorithms require fundamentally different hardware architectures before Amazon's current servers have paid for themselves, they could be stuck with tens of billions of dollars in obsolete equipment.
Just useless metal.
Yeah. If they are forced to rip and replace their data centers early just to stay competitive, that ruined cost structure could devastate their long-term profitability. That is the razor-thin tightrope they are walking right now between visionary investment and catastrophic capital destruction.
$147 billion tightrope. Wow. So to bring this all together for you, Amazon's Q1 2026 is a story of total AWS dominance masking a massive capital pivot.
A historic pivot.
AWS is growing at 28% with staggering 37.7% operating margins, heavily subsidizing the rest of the company. They are locking in the future of AI with multi-gigawatt, multi-billion-dollar infrastructure deals with OpenAI and Anthropic. They are driving down the physical costs of this computing by completely controlling the hardware stack through custom Trainium chips and the Nitro system. But the immediate cost of this strategy is a historic CapEx build-out that has intentionally vaporized 95% of their free cash flow today, all to physically own the AI infrastructure of tomorrow.
They are essentially building the utility grid for the next era of the internet.
They really are. And as we wrap up, I want to leave you with one final thought to mull over. We've established that Amazon is effectively becoming the underlying electrical grid for the entire AI revolution, supplying the custom chips, the data centers, and the foundation models for everyone else.
The infrastructure.
Right. But what happens to the global tech ecosystem when the company that strictly controls the grid also starts building the most advanced consumer-facing applications like Health AI or the quick desktop app on top of it.
It's a scary thought.
Are we simply watching a brilliant, aggressive business strategy unfold, or are we watching the rapid creation of an entirely new, inescapable kind of digital monopoly?
When the utility company that controls the power also manufactures all the appliances, well, the dynamics of the free market change permanently.
Exactly. Something to think about the next time an AI autonomously books your doctor's appointment or organizes your inbox. Thank you for joining us on this deep dive. Keep questioning the mechanics behind the headlines, and remember that simple top-line revenue number rarely tells the whole story. The real truth is always hidden in the physical infrastructure buried deep in the balance sheet. Catch you next time.